Welcome back to the Business Exit Value Strategy. In today's tactic, we will discuss the Goal 2 bonus real estate capital and 10 real estate equity benchmark examples. This is the Business Exit Value Strategy with one objective, 7 goals, and 500 tactics. Statistically, only 25% of businesses continue beyond 15 years. And only 25% of those will sell. Why is it only 5% succeed? We have analyzed mid-sized companies for over 20 years. There are proven methods and common mistakes to success. This is the business development outline for you, the principal, to finish well and have a future assurance with real estate investments. Now, let's jump into today's tactic. Equity example number 1 at 520 Shadowgraph in the California Silicon Valley. This condominium grew $70,000 in 18 months in the 1980s. It was the last division and one of the final units of the builder-financed development. Equity example number 2 at 13401 Vista Oaks, just north of Austin in Texas. This residential was purchased below market value for $200,000 for the home valued at $300,000, recognizing an immediate gain of $100,000. Equity example 3 at 1331 L Street in Washington, D.C. CoStar, the MLS of commercial real estate, if you will, purchased a building in distress for $41 million because it was vacant. They self-occupied it and a year later sold it to an investment company for $101 million. They gained $60 million in equity. Note, the 1-year time frame. Ask your CPA about the short-term gain tax rate versus capital gains rate after 1 year. Equity example number 4 at 320 11th Avenue in the Gulch of Nashville. In 2011, this condo project, which could not sell units, sold to an investment firm for $27 million. The firm converted the project into multifamily and occupied it with tenants, and then sold it for $37 million in 1 year. Equity example number 5. At 112 Long Hollow Pike, just north of Nashville, this vacant bank building was purchased for $1.9 million, leased out to Dollar General as a headquarters, and then turned around and sold it for $4.3 million within a year. Example number 6. At the Braxton, just west of Nashville. There are some longer-term holds. This condo development was created by a developer for $60 million. Bank of America finally sold it for $14 million, and now the units are being sold at fair market value. Equity example number 7 at 800 Brickell in the Miami Financial District was a long-term hold as well. This building was purchased in 2004 for $33 million, and in 2015 it sold for $111 million. Equity example number 8 at 777 Brickell. The SunTrust Bank building in Miami was purchased at $44 million and sold for $140. Equity example number 9 at 485 Brickell in the hospitality arena. This hotel in Miami was purchased for $37 million and then sold for $64 million. Equity example 10 at 55 Southwest Miami Avenue Road. This is another example of real estate being purchased below market value. This is on the Miami River in downtown Miami, where it was originally purchased for $1 million. Then it was purchased again for $3 million. You would think that was a pretty good gain, but then again, just 2 years later, it was purchased at fair market value at the time for $18 million. Stand by for this week's chance to win a free gift. If this tactic was helpful, please like this video. Also, please subscribe to hear more tactics soon. And you may order the book, Business Exit Value Strategy, have your people attend individual tactic online courses, or contact us at tobiasbalda.com. For a chance to win our weekly free gift, the Hope and Courage Anchorline hat, please submit a request or question in the comments section.